Imagine spending 40 years paying off a house that's now worth £500,000 and still having to choose between heating your living room and buying your grandchildren birthday presents. That's not a hypothetical. That's the daily reality for millions of pensioners across Britain right now, and a quiet revolution in how we tax property could be about to make it either much better or much worse. Today we're talking about the shift from council tax to land tax and what every asset-rich, cash-poor pensioner needs to understand before the rules change under their feet. Let's start with where we are. Council tax, the system most of us have grown up paying, is based on property valuations that are, quite literally, from 1991. Think about that for a second. The bathroom suites were avocado. House prices were a fraction of what they are today, and somebody in a government office decided that year's snapshot of value would determine what you pay for decades to come. Homes have been bought, sold, extended, and transformed since then. Entire streets have gentrified, and yet the tax band on your front door still reflects a world that no longer exists. Andy Burnham, now one of the most prominent voices pushing for reform, has called the current system highly regressive and argued that basing bills on 1991 valuations is not justifiable. And when you break down the numbers, it's hard to disagree. Under the current system, a typical family home in England pays an average council tax bill that is actually higher than what some multi-million-pound mansions in the most exclusive parts of London pay, with the average Band D charge across England running around £250 more per year than a £10 million property in Mayfair pays under the top council tax band. That's not a typo. Ordinary families are, in some cases, subsidising the ultra-wealthy simply because the valuation system is frozen in amber from over 3 decades ago. homeownersalliance.gov.uk. So what's being proposed instead? There isn't one single plan, but there are several serious ones circulating Westminster right now, and pensioners in particular need to understand each of them, because they land very differently depending on your circumstances. The most talked about idea is a land value tax, often shortened to LVT. In its purest form, this is a tax based not on the bricks and mortar of your house, but on the value of the land it sits on. The theory, which traces back over a century to economist Henry George, is that land value largely comes from location, infrastructure, and community investment, not from anything the individual landowner did. A patch of land near a new train station becomes more valuable because of the train station, not because the owner improved it. Supporters argue that taxing that unearned uplift, rather than taxing income or enterprise, is fairer and more efficient. Burnham himself has been pushing this line for years. Back in 2010, during a Labour leadership contest, he was already publicly advocating a land value tax and suggested it could replace stamp duty, describing it as a form of radical tax reform. More recently, he's argued that land in Britain is undertaxed and that the burden should shift away from work and towards wealth, property and land. Alexander & Co. Alexander & Company. Now, before anyone panics and assumes a full national land value tax is landing next April, it's worth being clear-eyed about the politics. Analysts who've looked closely at this say a complete Georgist-style land value tax remains politically very difficult to implement in one go, and that a more realistic path, even under a government sympathetic to the idea, would be a phased reform programme, gradually reforming council tax and stamp duty rather than sweeping both away overnight. That matters because it tells us what's actually likely to hit your letterbox in the next few years versus what's still mostly theoretical. Alexander & Company. Here's what's more concrete. There's a proposal from the campaign group Fairer Share, which Burnham is reportedly drawn to, that would scrap both council tax and stamp duty entirely and replace them with a single annual property tax set at 0.48% of a home's current value. To put that in real terms, a house valued at £300,000 would carry an annual bill of roughly £1,440. For some households, that's a saving. For others, particularly those sitting in homes that have quietly ballooned in value over the decades, it could be a significant increase. Homeowners Alliance. There's also a more academic but increasingly influential proposal from Professor John Muehlbauer at Oxford, and this one deserves special attention because it directly names the group we're talking about today. Muehlbauer's plan is two-pronged. First, replace the top two council tax bands, covering just over 1 million of the most expensive properties in England and Wales, with an annual charge of 0.5% of the property's value. Second, introduce a land value tax specifically on agricultural, forest and unoccupied development land above a certain threshold per hectare. What's notable is that Muehlbauer's own proposal explicitly builds in a simple deferral scheme designed to protect cash-poor but asset-rich pensioners. In other words, even the people designing these reforms recognise that this exact group, people sitting on valuable homes with modest retirement incomes, is the pressure point that could make or break public support for the whole idea. INET Oxford. And that pressure point is very real. Reporting on Burnham's proposals has already triggered what's been described as a political storm, with headlines warning that millions of homeowners could face sharply higher bills, and specifically flagging that pensioners and middle-income families are among those most anxious about what a modern revaluation could mean for their tax band. The core problem is simple, and it's one many of you watching will recognise immediately. Many older homeowners are sitting in houses worth dramatically more than what they paid for them decades ago, but their income in retirement, largely fixed pensions, has not grown anywhere near as fast as property values have. You can be sitting on an asset worth £500,000 and still be counting coins for the electricity meter. That's the definition of asset-rich, cash-poor, and it's precisely why any move toward value-based property taxation makes this group uniquely vulnerable. As one recent piece on The Backlash put it, families who spent years cutting back and saving to get onto the property ladder may feel they're being punished for gains they never actually turned into cash. Your house going up in value on paper doesn't put a single extra pound in your pocket unless you sell it, downsize, or borrow against it. And for a lot of pensioners, none of those options feel like real choices. They feel like losing your home. There's also a related but separate reform already locked in and worth knowing about, because it shows the direction of travel even before any full land tax arrives. The government has confirmed a high-value council tax surcharge targeting properties valued above £2 million. This won't affect the vast majority of pensioners reading this, since fewer than 1% of properties in England are expected to fall above that threshold. But it's a signal. For the first time, liability is being placed on the homeowner rather than the occupier. Values will be assessed by the Valuation Office agency rather than self-reported, and revaluations will happen every 5 years going forward, rather than being frozen for a generation. That precedent, homeowner liability, regular revaluation, external assessment, is exactly the machinery that a broader land or property value tax would need to actually function. So even if you're nowhere near the £2 million threshold, watch this space, because the infrastructure being built now is the infrastructure that could eventually apply much more broadly. So what should you actually do with all of this if you're a pensioner sitting on a valuable home and a modest income? First, don't panic, but do pay attention, because none of these proposals are currently law. What exists today is still, in the main, the existing council tax system, with existing protections. If you're struggling with your current bill, council tax reduction schemes already exist and are worth checking, particularly if you're receiving pension credit, since eligibility and support can depend heavily on your income and savings rather than the value of your home. It's genuinely worth speaking to your local council or an organisation like Age UK to see what reduction or discount you may already be entitled to under the current rules, because many pensioners simply aren't claiming support they qualify for. Second, Keep a close eye on deferral schemes specifically. This is the single most important concept for anyone in the asset-rich, cash-poor position to understand. A deferral scheme allows you to postpone paying an increased tax liability, letting it accumulate against the value of your property, rather than demanding cash you don't have right now. It typically gets settled when the property is eventually sold, often after death from the estate. Every serious proposal currently on the table that touches this group, including Muehlbauer's Oxford Plan, explicitly builds in some version of this protection, precisely because policymakers know that forcing cash-poor pensioners to sell their homes to pay a tax bill would be both cruel and politically toxic. If and when reform does arrive, the deferral mechanism attached to it will likely matter more to your day-to-day life than the headline tax rate itself. Third, think seriously and unemotionally about your long-term housing plans, regardless of what Westminster decides. Advisors are already noting that for many older homeowners, downsizing has long been a theoretical option rather than an active one. But a recurring value-based property charge, whatever final form it takes, tends to bring more urgency and clarity to that decision. That doesn't mean you need to sell tomorrow. It means having an honest conversation with family, with a financial advisor, or simply with yourself about whether your current home still serves you, or whether it's become a beautiful, valuable trap. Finally, stay engaged with the actual news rather than the panic headlines. Every proposal we've discussed today, the Fairer Share Plan, Muehlbauer's two-pronged model, Burnham's broader land value ambitions, is still a proposal. Political opponents have already pushed back hard. Farming groups have raised serious objections to land taxation specifically, and any government moving forward would almost certainly phase changes in gradually, rather than flipping a switch overnight. You have more time than the scariest headlines suggest, but you don't have unlimited time, and the households that come out of this transition best will be the ones who understood the direction of travel early, not the ones who scrambled when the letter finally arrived. The truth is, Britain's property tax system is genuinely outdated, and reform in some form is probably coming because it's very hard to defend a system where a modest family home can pay more tax than a Mayfair mansion. But fairness for the country as a whole has to include fairness for the pensioner who did everything right, worked, saved, paid off their mortgage, and now finds their only wealth locked inside four walls they can't easily turn into cash. Whatever shape this reform ultimately takes, the deferral protections, the exemptions, and the support schemes attached to it will determine whether this becomes a fairer system or simply a new way to squeeze people who have nothing left to give. If this video helps you understand what's coming, do me a favor and subscribe to my channel, because I'll be tracking every twist and turn of this story as it develops, and you won't want to miss the updates. Thanks for watching, and I'll see you in the next one.